Welcome back, everyone. Today, quickly, I just want to discuss some very high yielding Canadian dividend stocks that I have owned in the past and I think have some potential going forward. They all have their individual problems, but the yields are so high on these things that it is very exciting and tempting to a lot of us dividend investors. And, just I myself, I'm having a very difficult time not starting positions in these companies because the yields are so good and I don't see a ton of terrible problems going forward. I think these companies have potential and some macro environmental concerns are being a little bit overblown. So for the companies I've selected for today's video, I have two Canadian banks, CM and BNS. I have two Canadian telecoms, BCE and TELUS, and two very popular pipeline companies in TRP and Enbridge. Now on the screen here I have BNS, but most of what I'm saying is also applicable to CIBC. CIBC yields a little bit lower at around 6.8%. Currently BNS is yielding 7.14%, which is absolutely insane. All these companies I'm talking about today are freshly off their 52-week lows. They've had a little bit of a tick up, as you can see on the screen here, but nothing crazy. So everyone knows interest rates have been on the rise, and this is a big player here on the Canadian banks because the banks need to put away a ton of money for loan loss provisions. Now, this money is coming out of their earnings, and they can't distribute it. It needs to be in holding for a period of 1 year. So the banks are putting a certain amount of dollars aside. Now, if the economy does very, very poorly and they haven't put enough money away for loan loss provisions, then they're going to be in trouble because they need to pay their dividend, they need to pay their overhead costs, and they need to budget this correctly. However, if they over budget, and like they did in the pandemic, by the way, they put too much money away, then in a year's time, if things settle down, then that money can come back out and they can start buying back shares, they can make acquisitions, they can give it back to the shareholders in the form of dividend increases, anything they want. So in the past, they've over budgeted, and these are conservative Canadian companies. This is a good thing. So I hope that's the situation going forward. And in a year from now or 2 years from now, this is going to look like a ridiculous gift that these Canadian banks have dropped the amount that they have. Now for TELUS and BCE, I'm going to talk about these two as a whole now because they face the similar headwinds as well. Their headwinds are debt. Debt. Okay, if we take a look at TELUS and BCE's financial statements, you'll see that they have an astronomical amount of debt. They both issue more shares every year, and they both raise the dividend every year. So if there's more debt, if there's more shares, more dividends to be paid, well, that's going to take a toll. Okay, so it's not rocket science. Now, it doesn't mean these companies are in trouble. It doesn't mean these are bad companies. It just means that these companies need to be on top of everything and scrutinize their balance sheets. These two companies spend so much money in capex that it looks like they cannot cover the dividend right now if you take a look at their financial statements. However, this is not necessarily true because the capex cycles are just that. They're cycles. They spend a bunch of money, too much money, and then the next couple of years, they don't spend as much. So then it looks like they have way more than enough money to need to operate and pay the dividend, give shareholders back money. But right now they're in a high capex cycle. They're spending all their money on 5G, and that's not quite over. Burying the fiber optic cables costs a lot of money. Even on my street, I've seen a bunch of Bell trucks. They're digging up everyone's yard to put these new high-fangled technology. So once this period of capex spending is complete, then they'll settle down for a bit and everything will go back to normal, minus the debt that they have. The debt that they have will continue to grow, and unfortunately, the interest rates that they're going to be paying going forward will be higher. However, they do have some catalysts with all the new immigration coming into Canada. They have a ton of new customers. There are really only 3 major players in the telecom industry. Now, I just want to touch on the pipeline companies, Enbridge and TRP. They're both paying over 8% right now, which is absolute insanity. Now, we just talked about the debt load on the telecom companies. The debt load on those companies is nothing in comparison to the debt load on Enbridge and TRP. It's not even in the same universe, but the nature of the business is different, so we shouldn't really be comparing apples to oranges. Enbridge specifically just bought a bunch of more pipelines right now in this high interest rate environment, which I really am not in favor of. I actually don't like what they're doing right now. They had to dilute the shareholders and take on billions in debt. I sold this company earlier in the year. I didn't think things were going to go super well for them going forward. I don't think they're going to cut their dividend anytime soon, but I don't know what kind of accountants they have, but I think they're going to have some issues with their debt going forward, and it's almost time for them to raise their dividend again this year. I'm not going to buy any more of this company ever again unless management comes out and says, hey guys, we're going to put a pause on raising the dividend, and what we're actually going to do is start paying down debt until it gets to a reasonable level, and then we'll start raising it again in whatever number of years, 5-10 years. If they said something like that, then I would have full confidence in management going forward, and I would say, okay, this company is investable again going forward. I'm all in. And with TC Energy, honestly, their management's actually even worse than Enbridge, in my opinion. I really don't like what they've been doing with delaying pipelines, selling them off, splitting the company into two different companies. They're a bit of a mess right now. I'm out of that company, and I do regret ever investing in them and trusting management. So I've owned all these companies at one point or another, but going forward, I only own TELUS, and I think that CM and BNS present a great buying opportunity if you believe in the Canadian economy. These things are way, way undervalued. I'm not going to jump in and buy these right now. I need a couple more quarters of information. I've taken some profit out of these companies in the past year, so I'm just going to sit on the sideline and wait. My TELUS investment is way, way down. I'm not going to lie to you guys. I'm down, I think, 18%, which is pretty horrendous. However, I actually do believe in this company going forward. It's not bulletproof. Management can make mistakes and make my life difficult, but I do like them going forward. BCE is one I'm considering purchasing a little starter position in because the management has said a couple correct things, and I like that they're doing a bunch of layoffs. I know it's not a nice thing that they're laying people off, they have families, etc., but we need to strengthen the business so the remaining employees can feel safe, okay, and the shareholders can get paid. But the pipelines I just have no interest in currently, even with their north of 8% yields. This is my opinion, guys. Let me know if you guys think these stocks are a buy or a sell, or if I've missed some really good ones. I would like to know. Give them to me and I can add them to my watch list. But these are Canadian high yield dividend paying stocks that I'm interested in at the very least, and I hope you are too.